We're going to take a look at the latest report that we published in Seeking Alpha and the Associated Press. And we're also going to take a look at the economics that we have, the news that came out this morning regarding the unemployment claims, which were down more than 50% as expected. Welcome back here. Let's take a look at the latest report that we just published here this morning, and we can analyze the market afterwards and see what's going on in today's action.
Equity Management Academy, October 6, 2021. Gold. Prepare for a 20% rally from the annual lows into Q1, 2022. Summary. This morning, the government announced that unemployment claims finally fell after a month, but 4.2 million Americans are still receiving benefits. The labor market appears to be struggling less than expected. The gold market is showing a lot of buying action. The market is ready to move up again, but it may move down to test $1,765 again. We are probably going to make the annual low over the next few weeks. Fundamentals. This morning, the government announced that unemployment claims finally fell after a month, but 4.2 million Americans are still receiving benefits. The labor market appears to be struggling more than expected. About 326,000 people filed for unemployment benefits this week, down about 38,000 from the previous week. Economists expected about 345,000 claims. About twice as many Americans remain on unemployment benefits compared to before the pandemic. Gold. The CEO of the Equity Management Academy, Patrick MontesDeOca, said this news led to a bit of a sell-off in precious metals. Gold came down to almost the daily buy one level of $1,751, but then it reverted, activating a bullish price momentum. According to the artificial intelligence embodied in the variable changing price momentum indicator, VCPMI, the target is $1,771. The market is showing a lot of buying action. The market reversion back up means that, MontesDeOca said, the market basically discounted the fundamental news. He argued that raising interest rates will be bullish for precious metals. Raising rates is bearish for most instruments that are leveraged, but there will be less of that type of buying as rates rise, since there will be less borrowing and less leveraging in various markets. Precious metals have been in an inverted market since last year, he said. Gold hit $2,089, discounting the damage that the pandemic had caused. The market then declined back down to test the levels of support around $1,680. The 61.8% Fibonacci golden ratio retracement. Then it reverted back up again. The market is matching the Fibonacci wave model. We are in the beginning of a third wave. The market is ready to move up again, but it may move down to test $1,765 again. However, the VCPMI predicts that the market is far more likely to go up again. When gold came down to the weekly average of $1,733, it found a lot of buyers. It is also an area of support based on the daily data. For the monthly gold report, with gold closing below $1,785, the trend momentum was bearish. A close above $1,785 will negate this bearish momentum to neutral. The monthly price momentum of $1,772 was also bearish. A close above $1,772 stop will negate this bearishness to neutral. On the downside, the monthly targets are the buy levels of $1,707 and $1,756 for the rest of the month. If we trade through $1,772, we have targets of the sell levels of $1,823 and $1,888. For the weekly gold report, the weekly trend momentum of $1,783 is bearish, while the weekly price momentum of $1,749 is bullish. So we had a bullish price momentum within the larger bearish trend last week. So $1,777 and $1,793 are the weekly targets for this week, which is where you want to lock in your profits. The fact that the market reverted based on the economic news that came out, MontesDeOca said, is just icing on the case on top of the technical indicators. The fundamentals appear to be moving toward aligning with the technicals as we move into the third and fourth quarter of this year. We are probably going to make the annual low over the next few weeks. Any opportunity when the market comes down, add to your positions. We are about to complete a cycle and start a new 360-day cycle with great promise. The VCPMI is looking for a 20% to 25% rally over the next 2 quarters. Bitcoin. Bitcoin is at 55,160. On October 1st, we recommended to go long from the buy 1 level of 43,325, which is the first level of support using conventional technical analysis. This was an area where the VCPMI says you want to buy and go long. The market then came back up and reached the weekly sell levels, which were the targets of 51,245 and 53,009.
We seem to have a little bit of difficulty here. Bear with me. And basically, the report was completing that the targets on Bitcoin have been completed, basically. So why don't we go right into the market here and take a look and see where we are right now in Bitcoin here. Or the markets as we pretty much are trading with the bullish news that came out regarding the unemployment numbers that came out. Coming back into the market here, putting aside the fundamentals, the Bitcoin has completed basically the targets that we were anticipating of 51,245 to 53,935. So what do we do here now? Okay, well, if we take a look at the market in relation to the daily charts on the left of the chart, we have completed the sell one level of 56,082 with a high of 56,815. The next level, the next target is 57,438. It appears that on the daily, we met the target of sell one and reverted to a short trigger, to a short signal that came down and met the target of the mean of 54,968 and has activated now a bearish price momentum. By trading below the mean, it has activated the buy one level of 53,612 as the day target right now. Unless the market trades up above 54,968 using the 15-minute bar close, the position will stay bearish. Above the average price, it activates a bullish price momentum. Now, the interesting thing here in Bitcoin that we're looking at is right below the average price, we have the sell two level of the weekly number this whole week at 53,935. And if we get below 53,935, it's going to activate a short trigger within a bullish daily pattern that is indicating the market is in support. On the daily basis, the blue levels here are identified as an area, a strong area of accumulation of supply. So let the market trade the average price, which it pretty much tells us that it's standard deviation 50-50, so it can go either way in terms of your trade. And what I suggest my traders to do is to identify the highest probability trades in using these pivot points. One of the things that I want to clarify here for a little bit, and make my traders aware and my audience aware here that we are using pivot points, but it's beyond the pivot points artificial intelligence that incorporates the algorithm that is written in C++. Pivot points are the basis, you might say, of the work that we do. We include moving averages, we include directional movement, we include Fibonacci formulas, we include WD Gantt formulas within this simplistic picture that you see, that it's easy to identify the pivot points. But what the pivot points do not identify is the artificial intelligence behind the pivot points that essentially activates the pivot points to a probability model. And it tells us now, when the price reaches the sell 1 and sell 2 level, you're looking at a mathematical probability between 90 and 95% that if the price completes this pattern, upon confirmation, it will revert back down to the mean. This is what's called the reversion to the mean principle using pivot points. So we reverted back to the mean, and we are dealing with a 50-50 standard deviation. And so we're going to hold on to our position, basically, that we have put on, which is on the long side. It's looking for much higher prices. In fact, we're looking potentially for a test of the 58,000 target, all the way. Actually, 58,000 is our short-term target on Bitcoin, which represents a 78.6% Fibonacci retracement of the whole previous move that we made previously. This here represents 78% retracement of this move. And what we want to see is basically the action of the market as it approaches these levels and see what kind of supply we can experience. When the algorithm identifies the pivot points in red, it tells us that this is an area of high probability. Using conventional wisdom, it's resistance. And beyond the resistance levels here, the algorithm identifies exactly the entry points, and it tells you the methodology upon confirmation of the market, what is going to be your trigger point. If you use pivot points just alone, all they do is they give you different levels of support resistance, and you can use 5 pivot points up or 5 pivot points down. You can have 10, pivot point structure, and that's all you get is the levels. When we incorporate pivot points in the structure of the VCPMI, it uses a very specific structure. It uses a perfect Fibonacci structure of 5 levels, only, maximum 5 levels. And within those 5 levels, it identifies the average price. And once we can extrapolate that average price, obviously we can extrapolate the extreme levels above or below. Further than just that information, the AI tells you exactly when to enter and when to exit. When you enter what your protective level is, it gives you 3 levels of stops, and you as a self-directed individual can measure that risk according to your account. So what I'm doing here is for the basic understanding of self-directed traders or experienced traders, basically, that have tried to use all of these individual components individually, like myself. I used it for many years, and I found out that sometimes the standard deviation was, 50-50, which means that, 50% of your indicators are long, 50% are short, but you don't have any directional movement with high probabilities that tell you if the market trades below this level, go short. It's precise. And what I'm doing is reverse engineering for the benefit of you self-directed traders. I use this in my own account. I use it for the house account, and it gives me a tremendous trading tool that I use as a GPS when I want to go trading. And obviously, if you're a long-term investor, you don't even need to watch this video. If you are a day trader, swing trader, and an intermediate trader or long-term trader, you can use this metrics, as I said, as a GPS to guide your trading. We've taken some profits this morning on precious metals here. We've recommended my traders here in my live trading room to take some profits here this morning, lighten up, hedge, as the gold market reached the sell 1 weekly level of 1777. When it got up here, it activated the sell 2 level, but upon the reversion here that you see, it negated the signal and it activated a short trigger. Automatically, the average price is activated. The target was completed on the daily, the first target from selling 74. 73.10 was the signal here to go short, and the target is 17.59. If it completes the pattern, we're getting another short trigger from below 17.65. So we have now a daily and a weekly short trigger from 1777, 1774, and the target is 1759. You can see the chart giving us a pretty clear picture of the volatility that we're experiencing. And this is a fast market right now, especially after this economic news came out. So you can see the market coming down to the support levels that we have here. I'm going to add some trend lines just to get an idea. Where we are. We're down into the buy one level, as you can see, activating a short trigger. So when you look at this chart, all you see is the pivot points. And what I'm trying to explain to you is the artificial intelligence that is used in identifying the signals. And this is how the chart looks when it's basically showing you the different pivot points. So the AI behind the algorithm told you to get out at 1774, take profits, and of course you saw the market run up beyond that, and that's okay because you're neutral here. You took profits or hedged, and then it came down and activated a short trigger right away. You could take that short trigger and the target was completed below. Now it's neutral and it's activating another short trigger that essentially if it closes below here, we may want to take a short trigger. Now, it's trading below right now, and we got about 10 minutes. It looks like the market is going to be coming down. So this is an aggressive trade, and we want to sell. We want to go short at the market.
Order filled.
The algorithm is activating a short trigger automatically. When it does, the target below becomes active, and in this case, the initial target is 1758 for day traders. The markets are highly volatile, and you want to measure that volatility pretty much according to your profile. Measure the risk, don't overtrade, don't overleverage, and use the VCPMI basically to guide your trading. So it's activated a short trigger with a target of 1758, and automatically it gives you 3 levels of stops. A close above it, above the initial entry point, is the most conservative stop. The most aggressive stop is actually holding on to the sell 2 level, and a close above it will close out your position. The signal will go neutral. The system will go neutral. So you clearly have a structure in place for your day trading. Let's go back here to the other chart. And see what where we are. We are in activating a short trigger, but we are in the middle of trend line support level. So it's going to be interesting to see if the market is able to hold on to this level of support or come down to test the daily average of 1759. And ideally come down to 1750. Here is where the AI identifies for you the harmonic alignment, which is the highest, most probable entry point to go long. And that's at 1750 to 1749. And why is that? Well, the pivot points that we use activated by the AI is telling us that 1750 is the daily buy one level of support, and the 1749 is the weekly average price, which is pretty much harmonically aligning itself. When you identify this alignment that brings the daily and the weekly prices together, that is the highest probability, most optimal entry point the program identifies. The daily the daily pivot point of 1750 is pretty much at par with the weekly 1749. Now, the unemployment numbers that came out this morning roughly were about 190,000, expecting 500,000 new jobs. And it is a surprise to the economy. And it has taken the argument of the Feds to raise interest rates or to taper interest rates off the table. What this means is basically that there's a very high probability that the economy is going to go into a slowdown in the fourth quarter of this year. And with this kind of economic news, unemployment news, it's going to be very difficult for Chairman Powell to even talk about tapering or raising interest rates. In fact, what I do expect is for rates to reverse and go deeper, more negative than most people would think needs to happen. And so far, I think what the market is indicating is that we may be talking lowering rates or using some kind of Fed maneuver like repurchasing agreements, repo agreements, to manipulate the yield curve and synthetically bring down interest rates long term and invert the yield curve, as the short end of the curve may be affected by this supply squeeze that we have, this bottleneck of supply that is causing tremendous shortages short term. And so we have a conflicting fundamentals here. On one hand, inflation fears because of this bottleneck of supplies, and on the other hand, a slowdown in the economy. Is that stagflation that we're talking about? That's what it sounds like. But let the markets decide as we move into the fourth quarter of this year. Those are the fundamentals. Coming back to what the market wants to do here is the market has priced in basically the fact that interest rates are not going to go up. And we got up to 1782. Excuse me. What we need to do now is, now that we got this confirmation that rates are not going up, is let the market come down to test the levels of support. And the highest levels of support, or the entry points for you to continue to buy or add to your long-term outlook in the metals, which is bullish, extremely bullish. You want to look for the probability model to identify the highest probability entry points, and that is if the price comes down to 1749, 1750, that is an excellent high probability trade. Thank you once again, everybody, for the opportunity to share this incredible information with you, and until next time, my friends, be well. You take care, and I'll talk to you soon.